Okay, now I'm going to tell you how you should invest your money. So I will go straight to the point. You should invest in the S&P 500. Now all that is left for me is to tell you why and how it works. So what is the S&P 500? Well, the S&P 500 is an index that tracks the 500 largest companies in the United States stock market based on market cap. It is also a benchmark of the health of the stock market in the US. Okay, so let's take a look at the holdings of the S&P 500. So as a reference, I took the Vanguard VOO ETF. So as you can see here, the top holdings are Apple, Microsoft, Nvidia, Amazon, Meta, Google, and a few more. So the S&P 500 is also diversified on a few sectors such as technology, financial, healthcare, and more. And it touches most of the United States economy and also most of its, well, if not all of its largest companies. So here we're on the Vanguard S&P 500 website, and here a very important number is the expense ratio of their ETF, which tracks the S&P 500 index. So the reason why this expense ratio here is so important is because you want it to be as low as possible. What most people do is that they go with a fund manager that will manage their money for them, or they go with the bank, and what happens is that they pay up to 1, even 2% of expense ratio per year. So that means if they invest $100,000, they will pay $1,000 to the fund manager just so that he can manage the fund. That over time adds up very much and can cost you hundreds of thousands of dollars. I will show you that in just a moment. Let's take a look at how much those fees eat on your returns. So usually the S&P 500 returns 10% per year. So let's calculate it with a 9% return, with a 1% fee, and an 8% return with a 2% fee. So if you invest initially $10,000 and we keep that 10% return, 9% and 8% return, after 1 year, it's quite close, after 2 years as well. But the further you go, the more the spread widens. So let's say after 20 years, you would be $20,000 less with the 2% fee and $10,000 less with the 1% fee. And if we go even further, after 40 years, you're not even at half of what you would have if you would go with the S&P 500. So here you have 450,000 compared to only 217,000. Even with the 1% fee, you're still missing around $130,000. So the further you go, the more this 1 or 2% fee that might seem very small affects you very heavily. Let's check what a single dollar invested in the S&P 500 all the way back to 1885 would be worth today. So we're going to see four cases, one with the original S&P 500, one with a 1% fee, a 2% fee, and one where you would be beating the S&P 500 by 1%. So let's check it out. The S&P 500 would have returned your $1 all the way to $286,000 today. After all of this time, which is a huge amount of time, is just to illustrate a point. But look here, if you have a 1% fee, you would be at only 25% of your returns with $71,000. And with a 2% fee, it's even worse. You would be at around 6% of what you would have gotten with the S&P 500. You would be at only around $18,000. However, if you're able to beat the S&P 500 by only a single percent, you would be up 4 times more at $1.1 million. Let's say you're going to invest for 40 years. You start at 20 to 25 and you want to retire at around 65 years old. You're going to keep investing those $726 each month in the S&P 500 without fail, and I will still illustrate to you how it is very important to keep those fees as low as possible. So let's try to evaluate how much money you would have lost with a 1% or even 2% fee. So the plain S&P 500 would have gotten you $2.4 million, but if you add only 1% fee, you would still lose $600,000, and a 2% fee, you would lose $1 million. So the people, they don't really realize that they're losing that much money because they still see some growth and they still end up being millionaires, but they just don't see the potential that they could be obtaining if they went with the index fund instead. So that's why I'm insisting very much that you should check out the expense ratio. If it's higher than 1%, you should probably go out and go with the S&P 500. Okay, let's recap why you should invest in the S&P 500. So first of all, the S&P is quite diversified. It holds 500 of the largest US companies and it is spread around multiple sectors of the economy. Also, the way that this index works is that if one company underperforms the index, it will be kicked out of it and it will be replaced by another company. So that's why there are only around 500 companies, because if the company cannot keep up, it will be kicked out and a new one will take its place. So that means that you're always exposed to some companies that are able to produce some good results and are able to keep up. Also, the S&P 500 is quite low risk because of how diversified it is, and also because it represents the United States economy. So even though sometimes the market crashes, the economy is in the dump, and things are not going very well, in the long run, the index will keep going up. Over the last 100 years, it has consistently gone up to around 10.64% each year annualized, okay? In all of the history of the S&P 500, you could not have lost money if you had invested for more than 20 years. Let's take a look at the largest companies per year in the S&P 500. So we can see here that in 2000, 2005, 2010, all the way up to 2024, the top performing companies in the S&P 500, they change. This is because, as I said, when a company underperforms, even if it's one of the largest holdings, it will be downgraded or kicked out of the S&P 500 and it will be replaced by a stronger company. So by being exposed to the S&P 500, you're also exposed to all of those strong companies, and you don't know what company next year will be the strongest and the year after that. So by being exposed to the S&P 500, you will get access to all of these companies through the index fund. Investing in the S&P 500 is not only low effort and easy, it is also very low stress. Look here. The professional fund managers, which are managing hundreds of millions of dollars, are not even able to beat the performance of the S&P 500. After 1 year, only 30 to 40% can beat it, and after 20 years, fewer than 10% can beat the index. Why would you be paying someone 1 or 2% fee each year just so that they can underperform? Or why would you invest some of your time to read some earning reports, look for some companies online, do some research, if in the end you can simply invest passively in the S&P 500, save all of that time and get as good, if not better results? Warren Buffett is widely regarded as one of the greatest investors of all time. Okay, he has started to invest at around 11 years old and he has beaten the market by around 20%. So this person has seen it all. He was born during the Second World War. He has seen many crashes in the history. He has seen the Cold War. He saw the pandemic. He has seen it all, okay? And after all he has done, all he has learned, he still came to the conclusion that the S&P 500 should be recommended to everyone. He is so convinced that the S&P 500 is a strong investment that when he will die, he will allocate most of his wealth in the S&P 500. If you are interested in investing in the S&P 500 and you are Canadian and you want to buy it in Canadian dollars, you can buy the VFV ETF, which is the Vanguard S&P 500 in Canadian dollar. If you are in the US, you can choose either VOO or SPY. There are more out there, but these are the ones I recommend. And if you want, you can also go with VTI, which is actually the entire US stock market, and it overlaps about 80% of the S&P 500. For your information, all of these indexes in the S&P 500 are quite the same. As you can see here, the Vanguard VOO S&P 500 grew by around 19% year over year and around 92.87% in the last 5 years. So if we check SPY, which is Spider version of the ETF, it's just the name of the company. It has very similar returns, with 19% we had 19%, and in the last 5 years, 92%, around 92%. So it doesn't really matter in which you go. And for the Canadian version, it is VFV, 20%, 90%, last 5 years, 92%, and around 95%. So they're quite close. There are some small differences because some of them they give you more dividend, and the Canadian version is in Canadian dollars and it is not hedged. So that means that the price between Canadian and US dollars may affect the price of the stock, but it doesn't really matter which one you choose. They're all excellent. Hey, so that concludes the quick overview of the S&P 500. I very highly appreciate your time and I wish you the best.